Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Before I start, yesterday was the 2-year anniversary of the Canadian Money Talk YouTube channel, with hundreds of videos and hopefully useful financial education. So I celebrated that 2-year anniversary. Now turning to my thoughts on market happenings for the week ending July 1st, 2022. Looking at the indexes for the week, the TSX was flat. The Russell 2000, S&P 500, NASDAQ, and the Dow Jones were all down after a poor week. Oil and gold were down slightly once again for the week. The 3 major U.S. indexes dropped in the final hour of trading on Thursday to finish off the first half of the year. The S&P 500 ended up posting its worst first half of the year since 1970. The NASDAQ Composite, down more than 22% for the second quarter, finished its worst quarterly stretch since 2008. The Dow Jones Industrial Average posted its worst quarter since 2020. There's little spare oil capacity in OPEC and in the world in general, so I expect the oil prices to continue going up, at least until the end of the year. The lack of investment in oil infrastructure is causing the lack of supply. Only in the fall, after the driving season and the quote-unquote revenge travel are over, if the price is still high, possibly past $150 per barrel, would there be any likelihood of demand destruction when people get tired of paying the high prices and change their lifestyle? The US 10-year government bond yield is back under 3%, which will help stocks as people get into bonds for safety, also lowering the yields and making bonds be not as good an alternative to stocks as they were previously. Some experts say we are in a rally and that the market bottom is in because the commodity prices are coming down, including oil, and a slowing economy will lower oil prices. And so we have reached peak inflation, and inflation will soften from here. The central banks won't have to raise rates as much and will avoid a recession. Most of the bad news is already priced in. Others think the bottom of the market won't happen until the central banks stop their tightening. At the same time, profit growth is expected to decelerate in Q2, so the July quarterly reports will be worse than Q1 that we've just had. On the flip side, there haven't been any earnings warnings yet, so perhaps Q2 reporting won't be as bad as some people think. The Canada and US consumer sentiment numbers are the lowest they have been in 4 decades. Inflation is making people afraid to spend, but their spending power remains strong should they choose to spend. The US Fed has acknowledged the possibility of a recession, which becomes news and makes people spend less, thereby slowing the inflation and the economy. Keep in mind that the Fed and the Bank of Canada can only control demand. And while it would be great to increase supply of oil or have more people go back to work to reduce the supply side of inflation, that is not in their scope. The large job vacancies have been anecdotally starting to ease, with some high-profile technology companies having layoffs. The US GDP reported quarter-over-quarter numbers for Q1 on Wednesday, and it was down 1.6%, which the US market didn't like, as it's indicating a recession, but the market didn't really sell off. A negative number was expected. On Thursday, Canada reported the monthly GDP number for May as expected, up a 0.3% month over month. A US and Canadian recession is possible, but generally expected to be shallow and more likely in 2023 if it does happen. China and Chinese stocks could be a hedge against North American inflation, interest rates, and a possible recession because they are in a different part of the business cycle than North America. The Chinese government is cutting interest rates to stimulate their economy, and this will support the Chinese technology companies. Hopefully, the political climate will ease as well to help these crown jewel companies. Xi Jinping wants the Chinese economy to be running on all cylinders so he gets his third term at the Chinese government plenum in November. There's also the post-COVID reopening in China, giving Chinese stocks great upside beyond the jump off the lows they have already had. There is relatively little downside risk in China, in my opinion. The G7 countries met in Bavaria for an annual meeting. They reiterated their commitment to the agenda, a quote-unquote sustainable planet, but they reiterated their commitment to each other to coordinate as well. They have committed to spending $600 billion on infrastructure in developing countries. Until mid-July, when the Q2 reporting starts, we will be at the mercy of macro news only, with nothing specific to companies individually. Looking at next week, there's no significant earnings announcements as the world awaits Q2 earnings to start in July. Next week, looking at economic events, on Wednesday we have non-manufacturing numbers from the US, and the US Fed meeting minutes are going to be released to get a better idea of what they are thinking about interest rates. Thursday, we have US and Canadian imports and export numbers, which figure into GDP, and Friday is US and Canadian unemployment numbers, which show the health of the economy. That has been my thoughts in the news for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.